It happens to every investor sooner or later. You open your portfolio in the morning, expecting a normal day, but then one of your stocks is down 20%. No major news, no headlines screaming disaster, just a sea of red. And you're left wondering, what just happened? Stock crashes often feel random, but they're not. In this video, we're going to break down 5 real reasons why stock prices collapse, sometimes in a matter of hours. Each reason we'll explore today is based on actual market behavior. No hype, no guessing. From missed earnings to rising competition, these are the triggers that move billions of dollars in minutes. And to make it real, I'll show you examples from companies like Netflix, Meta, and even Tesla. If you want to understand how the market actually works, stick with me until the end. The first and most common reason stocks crash is simple. The company misses expectations. Every quarter, public companies release their earnings reports. These include revenue, profit, and other key metrics. Investors and analysts are always watching. They set expectations ahead of time. If the company fails to meet those expectations, the market reacts fast. But here's a twist. Even when the numbers are good, the stock can fall. What matters more than the past is the future guidance. A perfect example, Netflix in Q1 of 2022.
Overnight, Netflix stock plunging as much as 25% after the streaming powerhouse announced it lost subscribers for the first time in more than a decade.
But what really shocked investors was the forecast. They expected to lose even more subscribers the following quarter. The result? The stock dropped over 35% in a single day, wiping out tens of billions of dollars in market value. And yet the product hadn't changed. People were still watching, but confidence in future growth disappeared, and so did the share price. Sometimes stocks drop not because of what that company did, but because of what's happening in the broader market. This is where fear and emotion take over. One example is the collapse of Silicon Valley Bank, SVB, in March 2023. When the bank's balance sheet came under pressure, depositors panicked and rushed to pull out their funds. Within 48 hours, the bank was shut down. But that panic didn't stop there. Other regional banks like First Republic and Signature Bank saw their share prices fall 30%, 40%, even 50%, despite having completely different risk profiles. That's what we call contagion. When trust disappears from one part of the market, fear spreads, even to solid companies. During these moments, fundamentals take a back seat. Investors sell first, ask questions later. Next, we move from market-wide fear to industry-specific challenges. A company might be strong on its own, but if the sector it operates in is collapsing, it often goes down too. Take airlines during the COVID-19 pandemic. In 2020, global travel came to a halt. Flights were grounded. Airports were empty. Airlines like Delta and United saw revenues drop by over 80%, practically overnight. Their stocks followed, losing more than half their value in a matter of weeks. Not because of bad management or poor decisions, but because demand vanished across the entire sector. We've seen the same with oil companies during price crashes or tech stocks during interest rate hikes. When the entire environment shifts, even good businesses suffer. A company is only as strong as the people running it. That's why bad leadership, scandal, or poor decisions at the top can cause stocks to fall hard and fast. A famous example, Tesla in 2018. CEO Elon Musk went on a podcast and smoked marijuana live on camera. The media picked it up immediately. Investors were less than thrilled. That week, Tesla's stock fell about 9%, and its chief financial officer resigned. But investor trust in the leadership, however briefly, was shaken, and that's enough to move billions. Now consider the case of WeWork. Founder and CEO Adam Neumann was at the center of massive controversy. Reports of erratic behavior, self-dealing, and conflicts of interest crushed investor confidence. WeWork's IPO was canceled. Its valuation dropped from $47 billion to under $10 billion within months. Leadership matters. When the people at the top lose focus, the market doesn't wait. If you've made it this far, you already understand more about market mechanics than most retail investors. But this last reason is one of the most underestimated and the most dangerous. Let's finish strong. Even when a company is doing everything right, it can still lose to a smarter, faster, or more innovative rival. That's the power of competitive disruption. Look at what happened to Meta, formerly Facebook. In 2021, Meta was a tech giant, dominating social media and digital advertising. But then came TikTok. With its short-form, highly engaging videos and a younger, more active user base, TikTok exploded. As engagement shifted, Meta's growth began to stall. Advertisers started redirecting their budgets. Investors noticed. Between 2021 and 2022, Meta's stock dropped over 70%, losing hundreds of billions in market cap. Not because the platform suddenly stopped working, but because it was losing attention, and the market punished that quickly. Even the strongest companies can fall when a better alternative shows up. Let's recap the 5 most common reasons why stock prices crash: disappointing earnings or weak guidance, market-wide fear and panic, industry-wide headwinds, leadership problems or scandals, rising disruptive competition. Most crashes don't come from nowhere. They follow patterns, signals, and shifts in perception. And the more you learn to read those signs, the less likely you are to panic when it happens to you. If you found this breakdown helpful, give the video a like, hit subscribe, and turn on the notification bell so you don't miss the next one. Comment below. Have you ever held a stock that dropped unexpectedly? Which of these 5 reasons do you think caused it? Thanks for watching, and remember, understanding how markets work is the first step to beating them.